Hey everyone, welcome back to Corporate Decoder, where we unpack the big moves in the corporate world. And let me tell you, Xerox has had a busy quarter, especially when it comes to borrowing money. Today we're diving into Xerox's latest quarterly report, looking at how they're doing financially up to June 2025. It's a combined report for both Xerox Holdings Corporation and Xerox Corporation, so we'll get a good picture of the whole operation. We'll break down their numbers, talk about their big deals, and see what it all means for the company. And if you enjoy getting these insights straight from the source, make sure you're subscribed and join our Discord community linked below for more. Let's jump straight into the financial results. For the 3 months ending June 30th, Xerox reported a net loss of $106 million. That's a big swing from the same period last year when they actually had a net income of $18 million in the first half of last year. Revenue-wise, things are pretty flat. Total revenues were $30 billion last year, so revenue is stable but not growing much at all. And on the balance sheet, things are shifting. Total assets grew to $8.874 billion by June, up from $8.365 billion at the end of last year. That increase seems to be driven by a jump in inventories and a significant rise in goodwill on the liability side. Total debt went up quite a bit from $2.814 billion in long-term debt at the end of last year to $3.484 billion by June. This increase is mainly due to new borrowings related to their big acquisition. Now let's look at cash flow. For the first 6 months of 2025, Xerox used $100 million in cash from operations. This is a big change from last year when they actually generated $44 million from operations. They clearly spent more cash on investing, with additions to property, plant, and equipment, and notably they brought in a huge amount of cash from financing activities, $450 year, when they actually generated $49 million. This was primarily from issuing new debt, as we saw earlier, while also making payments on existing debt. The numbers for Xerox Corporation, the main operating company, are very similar to Xerox Holdings, which makes sense since Xerox Holdings owns Xerox Corporation. They also reported a net loss for the quarter and the first 6 months, and revenues were nearly identical. Similarly, the balance sheet for Xerox Corporation shows a rise in total assets and a significant increase in long-term debt, matching the trends seen at the corporate level. And Xerox Corporation's cash flow also shows a use of cash from operations and a substantial inflow from financing activities, mostly due to debt issuances. Before we dive deeper, it's important to note that Xerox changed how they report their business segments. They used to have 2 segments, Print and Other and Xerox Financial Services. Now they've realigned to Print and Other and IT Solutions. This change came partly from acquiring a company called Isavi, and it means some prior period numbers were restated to match the new structure. Xerox has a pretty hefty goodwill balance, almost $2 billion. They do an annual check for any potential drops in value, and because they changed their business segments, they had to reevaluate their goodwill. Happily, their latest checks in early 2025 didn't show any issues, even with some stock price wobbles. But they do warn that if things change, like economic conditions worsening, future impairments are possible. Let's look at revenue breakdown. The United States is their biggest market, bringing in $930 million in the quarter. Europe is the next largest at $430 million. Equipment sales are down compared to last year, both in actual dollars and in constant currency. Post-sale revenue, which includes services and maintenance, is doing a bit better. You can see the impact of the company's strategy on their balance sheet. Inventories grew significantly from $695 million to $871 million. This could suggest they're building up stock, perhaps in anticipation of demand or due to supply chain issues. Meanwhile, other current assets also saw a big jump from $212 million to $731 million to $731 million, the reasons for which aren't immediately clear from the numbers alone. Xerox's accounts receivable, meaning the money customers owe them, grew from $796 million to $862 million. Their allowance for doubtful accounts, which is money they set aside for customers who might not pay, also increased slightly, but as a percentage of total receivables, it actually went down a bit from 8.0% to 7.7%. This is a good sign, showing they think their customers are getting better at paying up. The company is still working through restructuring programs from their reinvention initiative. In the second quarter, they incurred $10 million in restructuring and related costs. For the first 6 months, these costs were $9 million. While these costs are significant, they're much lower than last year, which had $51 million in restructuring costs. The bulk of these costs seem to be related to severance and benefits for employees they're letting go as they streamline the business. This is where things get really interesting. Xerox has been very active in the debt markets. In April, they issued a lot of new debt. $400 million in 10.5% senior secured. First lien notes and another $400 million in 13.5% senior secured. First lien notes and another $400 million in 13.5% senior secured. First lien notes and another $400 million to the second lien notes. The big reason for all this borrowing, the acquisition of Lexmark, they used the proceeds from these new notes to help fund that purchase. They also paid down some existing debt like $95 million on their Term Loan B facility and $90 million on their Term Loan B facility and $90 million on their Term Loan B facility and $90 million on their Term Loan B facility and $90 million on their Term Loan B facility and $90 million on their Term Loan B facility and $90 million on their maturing 5% senior notes. It's a major financial shuffle. And the debt activity didn't stop in June. On July 1st, just after the quarter ended, they completed the Lexmark acquisition for about $820 million in cash, plus assuming $327 million of Lexmark's debt. To help fund this, they also issued another $257 million on its term loan. It's a lot of debt, and clearly a big strategic move in 13% senior unsecured notes. Plus, Xerox Corporation took out an additional $27 million on its term loan. It's a lot of debt and clearly a big strategic move in dollars in 13% senior unsecured notes. Plus, Xerox Corporation took out an additional $27 million on its term loan. It's a lot of debt and clearly a big strategic move. Looking at their liquidity, Xerox Holdings ended June with $985 million in cash equivalents, and restricted cash. That's up from $631 million at the end of last year, largely due to the new debt they took on. Total debt is now $3.9425 million for the year, which is down from their earlier forecast mainly due to higher tariff-related expenses and costs for integrating Lexmark. You'd expect operating cash flow to be around $345 million for the year, which is down from their earlier forecast, mainly due to higher million for the year, which is down from their earlier forecast, mainly due to higher tariff-related expenses and costs for integrating Lexmark. This company is truly in a massive transformation. They've taken on a lot of debt, especially to acquire Lexmark. The revenue is stable but not growing, and they're still dealing with the costs of their reinvention plan, which includes layoffs and streamlining. The financial picture is a bit mixed. On one hand, the acquisition of Lexmark and a new IT solutions segment show a clear and heavily integrate Lexmark and deliver on their cost-saving promises. They could really turn things around. But if the integration is bumpy or via strategy to move into higher growth areas. On the other hand, the increased debt and a net loss for the period, coupled with a cautious outlook on cash flow, raise some concerns. They're betting heavily on these strategic shifts, and the Lexmark deal to pay off, it feels like a high-stakes play. If they can successfully integrate Lexmark and deliver on their cost-saving promises, they could really turn things around. But if the integration is bumpy or if economic conditions worsen, that significant debt load could become a real challenge. The drop in their dividend also signals financial tightening. Alright, that's our breakdown of Xerox's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. And don't forget to check out our Discord in the description for more exclusive content and discussions. Thanks for watching. See you next time.